Have you ever wondered what happens when you return to India on, let's say, 1st of August after spending years building your career abroad? Imagine this. You've been living and working in United States and you decide to move back home in the month of August. Suddenly, you find yourself in a very complex situation where both India and US considered you as a tax resident for the same financial year. The US sees you as a resident because you lived there for more than 183 days, and India also considers you as a resident because from August onwards you will be staying for more than 182 days in the Indian financial year. Now you are facing the possibility of paying taxes on the same income in both countries. Sounds familiar, right? You are not alone, and there is a solution to this. So before I start with that solution, if you are new to my channel, I am Alok and I am a certified financial planner here at Prime Wealth. Our firm specializes in helping NRIs with cross-border investment and taxation and plan their return back to India. So coming to this dual tax residency situation, which has now become very common amongst NRIs, when you are caught with such kind of tax system between two countries, both countries want their share of your worldwide income. So without proper planning, you could end up with an effective tax rate that might exceed 50 or 60% also in many cases, which is financially devastating. The United States considers you a tax resident if you have lived there for more than 183 days in a calendar year, which is from Jan to December, or let's say if you meet a substantial present test in US. At the same time, India's rule make you a tax resident if you are physically present for more than 182 days during a financial year, but from April to March. Now this overlap between two systems creates something called as dual tax residency, but it's not as complicated as it sounds like. One more reason why this is very common amongst NRIs is because NRIs make their move in the month of June or July when there are holidays to school to make that transition very easy. And that's where exactly this dual residency come into picture. So you might have heard of DTAA, and the DTAA between India and United States saves you from this situation. This comprehensive document recognizes our country's relationship and provides a very clear set of rules for this exact situation. Now the fundamental principle is very simple in a DTAA, that you should not be taxed twice on a same income. DTAA achieves two main mechanisms here for any returning NRI. First is determining which country has the primary right to tax any specific kind of income, and also to provide a credit for taxes that is already paid in any other country. It doesn't eliminate your tax obligations, but it ensures that you don't end up paying taxes twice and depending on the appropriate taxation in the country. So when you are tax resident in both countries, DTAA applies a series of tests to determine your primary tax residency, which is clearly shown in the Article 4 of DTAA agreement. Now if you check Article 4 of India-USA DTAA agreement, first you will find that it looks for your permanent home, which means where you have a home available for you. Now it might be in both the countries also. Secondly, it also examines what is your center of vital interest, like where are your personal and economic relationships and where it's more stronger, including your family, your business interest, your primary bank accounts. It changes from NRI to NRI. And if these cases are not clearly determined, DTAA also looks for your habitual abode, which means where you normally live and spend most of your time. And finally, if none of these tests are met, you have to provide a clear answer with what nationality you come from before deciding the tiebreaker. Now, one needs to start by determining your residency status clearly through very careful documentation also. To take benefit of this tiebreaker test, you need to keep a track of your physical presence, your day-to-day passport stamping, your maintaining your home records, your maybe rental agreements, bank account locations, and your family residences. That is where we'll be able to use this tiebreaker test. Only once you have established your primary tax residency through this DTAA tiebreaker rules, you can manage your actual tax obligations. Different types of income are treated very differently under DTAA. Your employment income is generally taxed where the services are performed. Business income where the business actually occurs or where the contracts are being signed of the business. And investment income usually follows very specific rules, like dividends have a different rate of interest, capital gains has a different rate of interest, and the concept of foreign tax credit also comes into picture in these situations. This allows you to reduce your tax liability in one country by the amount of tax you have already paid on the same income in some other country. So for example, in India you will file something called as Form 67 to claim credit for the foreign tax credit by providing right documentation of your foreign income, maybe documents like your US tax returns, your W2 forms, 1099 forms. Similarly, if you are coming from US and you want to take credits in India, you will have to use something called as Form 1116. The key here is to maintain meticulous records of all income sources and tax payments. Any gaps in the documentation can result in denial of claims and also double taxation. The most frequent mistake includes inadequate documentation, these timing mismatches, and not looking at the right deadlines between two different tax years. Your income characterization and figuring out which category does the income qualify into, and also late return filing in some cases. Like the financial years for both the countries are completely different, and it comes with their own complications and deadlines. Many people assume that moving to India automatically ends your US filing obligations, which is often wrong. Others don't maintain proper records of their foreign income, their taxes paid, making it impossible for us also to claim foreign tax credit for you. The solution is very simple. You need to have right records, you need to understand the requirements in both the countries, and also seek professional help in such complex situations. You can also consider taking a help from somebody who is like a chartered accountant and a CPA in both the countries and understand the tax situations, and also somebody like our firm who not only understand taxations but also how do you make sure you do the right transition between your retirement accounts like your 401k, IRA and all those things. You should look for advisors who know how to rightly interpret the DTAA and do the right tax filing for you. So critical compliance deadlines in India usually include 31st of July, which is extended for this year, but for US it is usually 15th of April. So coordinating between these two systems is essential, and you often need information from one country's return to complete the other country's returns. Also, there has to be some strategic consideration, including the timing of your return to India and the tax year that you will be falling into, because for salary income your timing can be different. But if you're running a business, let's say an S Corp, C Corp or an LLC, then your timing has to be slightly different. In many cases, people also misinterpret the RNOR tax status, which applies for certain kind of income but does not apply for many income like your business income also. So make sure that whenever you are returning back to India, to handle these transitions, you consult somebody who is an expert and has already done this with many other NRIs. If you like this video, share it with any US based NRI or any NRI who is planning to come back to India, so that their transition is smooth and they don't face any difficulties. If you like this video, join my NRI only WhatsApp community, for which the link is in the description below. Thank you, and I'll see you in the next.